Welcome back, students who are taking financial accounting. And in this series of videos, we're working on the Chapter 5 assigned homework problems from Group B. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you do not understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. Okay, so in this video, we are working on problem 5-51. And we'll see if we get the 5-52 because these seem to be relatively simple. SoCal Sporting Goods uses the LIFO inventory method and values its inventory using the lower of cost or market rule. Okay. SoCal Sporting Goods had the following balances on December 31st prior to releasing the financial statements for the year. Okay. So the ending balance of inventory is $75,230. Cost of goods sold is $360,450, and the sales revenue is $514,340. The accountant for SoCal has determined that the replacement cost, the current market value of the ending inventory for December 31st is $73,850. So remember, they're using the lower of cost or market rule. Okay, so the lower our cost is, here at 75,230. The market is 73,850, and we're looking for the lower of the two. All right. So, which accounting principle or concept is most relative to SoCal's decision to utilize lower of cost or market? And that is the conservatism principle. Okay, which means that you want to decrease the value of something if it seems unrealistically high. Okay, you're basically trying to keep your books conservative, so that there are no surprises. Like if you're overstating your inventory, that's not a good thing. If the market is saying that we have 73,000, as the value of that inventory at this point in time, even though we paid 75,000, we're going to want to use whatever the market will bear at this moment in time. Now, if we paid 75,000 and let's say the market says it's worth 78,000, okay, well then we're going to want to use what we actually paid for, all right, in order to be conservative, all right. What value would SoCal report on the balance sheet for inventory? So they're, because of the lower of cost or market rule, we're going to use the 73,850. Okay. I'm sorry. Yeah. We're using 73,850 because it's lower than, it's the lower of the two. Okay. So, you can always just think of it as, whichever one is lower, what we actually paid or whatever, the market will bear. Okay. In small businesses, this generally doesn't come into play. You don't even really consider it, okay? You would just always, use your inventory. But if you're talking about a bigger, let's it just popped into my mind. Let's say your Caterpillar, Caterpillar. They have they sell the backhoes and things like that, dump trucks, whatever have you. Okay. The market can't, because they're such big items and they're, costly, they're, they can, they know how much they pay for an item, but the price will, the market can go up or down because remember, they're worldwide. Okay. So it is a big company, and what the actual market will pay for a backhoe can be very different from what they actually purchase it for. Okay, so it might make sense for them to, do the, get a figure of, whatever the cost for market would be, and then compare that to, whatever their actual, their actual costs are, and use that to report on their financial statements. I mean, that was just an example that just quickly popped into my head. Okay, so it says prepare an adjusting journal entry required from the information given. Okay, well, what are we doing here? All right, so, the date is December 31st. Okay, and our inventory is 75,230, but we're saying that we want to show it at 73,850. So the difference between those two is $1,380. So we're going to reduce our inventory. Well, inventory is an asset where you reduce our assets on the credit side, so we're going to credit our inventory by $1,380. And debits have to equal credits, so we debit something else. And what do we do with inventory? We move it over to cost of goods sold. So we're going to debit our cost of goods sold for $1,380, and that's all there is to that. And when you do this, you will want to write, and you're making your journal entries, you will want to write a description. Now, because this is an out of the ordinary journal entry. Normal everyday journal entries, when you make a sale or you pay a bill or whatever have you, you don't really need to write descriptions for your journal entries. But whenever you have something that's out of the ordinary, and this definitely is something out of the ordinary, you'll definitely want to write a description so that whoever looks at it understands why you're moving from inventory to cost of goods sold, because they can, they're looking and saying, oh, okay, well, my inventory was 75,000. What's this journal entry for 1,380? Right? So write a description that makes sense. So write inventory down to market value. So you'll always want, for these strange, out of the ordinary journal entries, always write a description. I know that for chapters 1, 2, 3, 4 so far, and up to 5 here, I've never written a description. Okay, that's because they were always just plain Jane journal entries. But this one here is a little bit out of the ordinary, and like I said, for that, we definitely write a description. Okay. All right, so that was 51. Let's see here. 52. Okay, so this here problem is basically the same thing. We're looking at lower of cost or market, but notice that the information is being presented differently. Okay, what pops into my head is, I don't know how to do this. I don't get it. Well, that's because if you're going to look at, try to mimic exactly what's in the book instead of understanding the concept, then no, you're not going to find a solution for this problem. If you understand the concepts, it doesn't matter how it's presented. You're able to adapt the concept to the situation and be able to get the correct information. And this problem basically is the same exact problem as 5-51. Right? It's just that the information is presented differently. It says here, due to nationwide recession, Freezit Corp's merchandise inventory is gathering dust. It is now July 31st, and the $160,500 that Freezit Corp paid for its ending inventory. So here's my inventory, okay, and my ending inventory is $160,500. It says the Freezit Corp paid for its ending inventory is $11,200 higher than the current replacement cost. All right, replacement cost is the market. All right. So if their inventory is $160,500 and it's $11,200 higher, right, than its replacement cost, $395. So the actual the current market value is $159,000 No, that's not right. Let me get my calculator here. 160,500 minus 11,200 is 149,000. Yep, 300. So it says here it's collecting dust. On July 31st, the 160,500 paid for its ending inventory is 11,200 higher than the current replacement cost. So this is the current replacement cost. So now we have 3 bits of information. We have what we paid, we have what the market says it's worth, and we know how much the difference is. Before any adjustments at the end of the period, Freezit Corp's cost of goods sold account, so our cost of goods sold account has a balance of $671,000. Freezit Corp uses lower of cost or market for its ending inventory. All right, so the requirements. What amount should Freezit Corp report for inventory on the balance sheet? Well, remember, on the balance sheet, if we had inventory, and we're putting the actual amount of 160,500, that is greater than what our market will bear. Our market says it should be 149,300. So the amount that we should have on our balance sheet should be this $149,300, okay, because the lower of cost or market. Then number 2, what amount should Freezit Corp report for the cost of goods sold? Well, we have to take, if we have 671,000 in our cost of goods sold currently, if we're going to reduce our inventory by 11,200, that means we have to add it to our cost of goods sold, which means we have $682,200 would be the amount that we would report on the income statement for cost of goods sold. Okay, and of course the journal entry to do that would be this would be dated 7/31. We're reducing our inventory. Inventory is an asset, so when we reduce our inventory, reduce assets, we credit our assets. So I'm going to credit my inventory by 11,200, and debits have to equal credits. So I debit my cost of goods sold for $11,200, and then of course I would write down inventory to market value. Okay, so that would be my journal entry that I would use in order to write down my inventory to transfer that value from inventory over to my cost of goods sold. And of course I'm going to write in the description because that this is an out of the ordinary transaction. So the thing about this here is notice, it's the exact same thing that we did in problem 5-51. Okay, the only thing that's different is that the way the information was presented. But if you understand the concepts, then you work with the information the same exact way. Okay, all right, so if you have any questions, feel free to contact an instructor, and I'll see you in the next video.